Us more on this, we have Bhise, the banking research analyst of JM Financial Institutional Securities, who joins us now. Sameer, thanks for joining in. Your thoughts on the numbers, and what kind of valuation and target price upside do you see from Kotak over the next, say, 6 to 12 months?
Yeah, hi, thank you, good morning. So I think numbers were pretty strong on Kotak, expectedly so, given what was happening on the private sector side for other banks also. Margins have held up well, in fact, expanded a bit, fee was strong. Deposit growth, which has been the bugbear for the entire private banking system, it has come out quite well for Kotak and generally for private sector banks. We watched results from PSUs, which probably are beginning this week. But so far, the outcome has been quite healthy. Specifically with respect to Kotak, we think in the extreme short term, the stock has fallen quite a bit. We have a hold rating with a target price of around 1760. So some near-term pullback is quite likely. Though I think going back to the prior multiples will take RBI's green signal on what embargo they have put in. I think that will take some bit of time. But in the extreme short term, I think obviously it's fallen quite a bit.
Okay, all
Given
right.
Where valuations, you can't rule out a minor pullback to normalcy.
Okay, Sameer, point well taken. Then near term, it has some triggers. Good morning and welcome to the show. Nigel on this side. You know, there have been two big underperformers in the private banking space. Kotak Mahindra Bank, which now in the near term, you said it has some triggers. And the other one is the big boy, HDFC Bank, still reeling under pressure post that merger. Valuations, it has support. Between these two underperformers, what would your preference be?
We will prefer HDFC Bank at this point in time. We think large part of the pain is already behind with respect to the merger, the integration, the costs, as well as expectations on growth have now been reset. I think from a valuation perspective, from an ability to show growth on that base, I think they have come with a strong set of numbers in 4Q. And any sustainability should drive re-rating from here on. Also, one has to acknowledge the fact that HDFC will be relatively better placed in a declining interest rate environment, which obviously over the last 12 months, it has gotten postponed every quarter. But at some point in time, if we are in a declining rate environment, I think HDFC will outperform. But between the two, as you asked me, I think HDFC is our preference.
Sameer, hi, morning. Do you have coverage on NBFCs, PFC, REC, etc.?
We have coverage on NBFCs, but I think given the disclosures, we would like to stick the discussion only to banks right now.
Okay, all right. Without going into details specifically about any specific name, Sameer, I hope that should be fine. What do you make of the RBI's sort of framework, the rules that they put out in the sense for rules for project finance? There's a fair bit of
so I think firstly, one needs to keep in mind that these are draft guidelines and comments are awaited by 15th of June. Our sense is in the current form, it is quite onerous for most lenders to comply and ask for 5% provisioning on a standard asset. Especially when we are looking at a phase probably where economy is gearing up for the next capex cycle. It would be slightly putting it back by a couple of steps if this is implemented. Having said that, in terms of our banking sector coverage, we have just put out a note that private banks will, if it goes through in current form, private banks will have a relatively less impact. While PSUs have a higher share of project loans on their portfolio. So I think potential impact could be anywhere between 15-20 basis points on credit costs. While that number will be less than half for private sector banks. But obviously, we need to watch in what form does this come through. I think in current form, it's a bit of a negative. Because what this does is that project IRR from a lender perspective actually gets twisted a bit. So either you pass on the higher cost to the borrower, which in turn would lead to higher project financing costs. Obviously, as an economy, we don't want it at this stage. So
What
we need
could
to
be-
watch how. Yeah.
Yeah, actually, both stocks, PFC and REC, are down 5%. I mean, just for our viewers. Samir, what could be these are draft guidelines, and maybe we will see changes by the time the final things comes out. But as you said, I mean, what could be the motivation behind this? Is the RBI seeing something?
So I think, as you would see, RBI has been quite vigilant last few years, especially with respect to any kind of corporate or retail loan. I think as we gear up for a new capex cycle as an economy, they want lenders to be fully prepared for any potential volatility that comes up, and especially given the experience of the last decade. Given RBI, the vigilant regulator they don't want to take any chances. We need to see what could be the final shape of these guidelines. But I think that seems to be the only motivation that we saw a significant asset quality worsening cycle between 2013 to 17, 18. We obviously don't want a repeat of that, and hence they want lenders to gear up for it upfront.
All right. Samir, we'll leave it there. Thank you very much for your time. Appreciate you joining in.